In this video, guys, we're going to look at 5 signs that a company may well be failing. Stay tuned. Hey traders, warm welcome to Alright, so what are the 5 signs, or at least 5 things that you can look at to see if a company is failing? Not just from a chart perspective, but generally. We know the score, guys. We've seen things like Blockbuster, how they failed. We've seen some of the other companies that haven't adapted and they've been absolutely hammered. So what are the things we can look for? Well, the first one, the most obvious one, is a broken chart. What is a broken chart? Listen, there's a difference between a pullback and just a chart that just looks awful. A chart that looks awful will have had the highs years ago and days were good, everything was fine. And it'll literally just be like this. It will be grinding lower. There won't be any two-way trade. It will be grinding lower and lower. The valuation of the company is effectively just declining day after day, or at least week after week. You might get little pops up, but they get sold into, and it keeps going and going lower and lower and lower. And you get this, and it's continued, and it's going to take a lot for it to move back. In the early parts of this decline, and if you look at some of the kind of patterns of this, the earnings misses are quite dramatic, right? Because they start around here, and people are like, whoa, they've missed earnings. They're already a little bit nervous, they've come off the high, but then they start missing earnings. They start having profit warnings. Bad things start happening, and so you start getting more extreme moves. Later on in the chart, the earnings have been baked in as being bad. There's no more, the expectation is, because the expectation is still bullish, and when they miss is where you get the kind of gaps lower. Later on in the chart, then they've already put the bad news out there, like, listen, we're going to lose money next quarter. We're going to lose money next quarter. Here's the number, here's the number, here's the number. And it just causes the grind lower. And so, yes, you might get spikes up in earnings, actually, which is slightly different because they might lose less than they said they were going to. But inevitably, though, will get ground down. That's the key of a broken chart. If that gets taken down again several days later back to where it was, people know it's still bleeding money. It's still a dying industry. The company is still in trouble, regardless of whether they've lost a little bit less than they thought they had. So it's very short-term bullish, and you start to see this is what makes a broken chart. Bullish news, which is still bad news anyway, is sold into. And you get the earning misses. Then later on, like I say, you get some earnings beats, but even if they're small beats, they get hammered again straight away. Then you just start to get lower, you get this increased volatility. You go through this phase where the chart will kind of grind lower, and then you get, when it's really almost like on his deathbed, you get this real spike in volatility, because you start seeing days where it spikes up 10%, because 10% of the market cap where it's at now is meaningless compared to where it was. And so you get these spike up in price, and you get spikes down, and it gets much more volatile. And if you're kind of plotting an ATR on this, you'd see that would spike up dramatically in a percentage term anyway, as it starts to go lower. Really struggling, lots of news flow, especially at it's kind of the end of the cycle. Perhaps they're running out of money, perhaps it's this, little lifelines, people piling because they think it's going to change, the company is going to go back to where it was, and so the increased volatility is there. Then you've got key players leaving. So normally the players leave a little bit earlier rather than the death, because on the death you sometimes see them holding out thinking, well, there's no point in leaving now, I've got a chance to turn this thing around. You start seeing key C-level guys leaving, different people coming in potentially, or stories about why they've left, and it's just kind of, it's smirked over, it's spun a little bit differently. But the fundamental thing is managers are spotting that this is dying, and they're out of it before it's a sinking ship. The good ones anyway, they kind of say, listen, we can't change, we're trying to implement change, for whatever reason it's not going through. I'm going to move on to something else. I don't want to be sitting on the sinking ship here. We've tried what we can, and so you might find in the sort of phase 2, if you like, a lot of the key people are leaving. And then number 5, guys, is if you're in a business to consumer, or if you're in a retail space, or something like Blockbuster was, for example, you're going to see the Google trend search declining. And also, I mean, that's a way of seeing it broadly across the country, wherever you are. If you see the Google trend, you can put in, you can see the search is declining. That's a good enough indicator that actually they may well be struggling, because the less people are searching. You think about it, especially that example, like a Blockbuster example, you want to rent a movie, you're going to go, where's my Blockbuster? Okay, I'm going to put it here. The fewer people that are doing that, the fewer people are obviously renting movies. And also observations by myself, especially if we're in this, say, customer facing, consumer facing sector. If you're going into a store and you realize, hey, this store is always quiet, it's always quiet, that then combined with the rest of this could indicate that that thing's struggling. I know that we've had stuff in the UK like Mothercare, for example. No one's ever in there. It's not a store that I go into regularly anyway, but just nobody's in there. People like WH Smith's, Next, all these stores that are kind of declining and they just don't seem to be doing anything to get anything back. Often those charts are very much like this. And so these are the combinations that you look for, guys. It's broken chart, which is the big one, the earnings misses, the increased volatility, key players leaving, and just observations by decreased Google search volume. Any observations by yourself. How do you trade that? Well, you've got to be very careful if you're shorting it late into the move, because like I said earlier, sometimes these lifelines come and it will spike up 50% over a few days, which is no point because the short's only going to go to zero. So if you're going to get involved in this, maybe you wait for the short after you've had these spikes into the downside. So wait for good news, see how the response is, then short these for a pushback to lows. Or if you're on early and you recognize this, then obviously the short ride down here. Longs, yes, there are potential, and very often you see this. Actually, we saw this with Mothercare, real hammering, and then quite a decent move up, like a doubling before it revisits the downside. Hard to get on, it's tricky to kind of judge those, but if you kind of use some technical price patterns based in that and go, no, I'm not going to hang around on this, then maybe there's an opportunity there. But without that fundamental change, ultimately, if they're bleeding money and stuff, then inevitable is going to happen. It's just if there's any lifeline. So the better trade, in my opinion, is to wait for some lifeline that everyone gets all bullish about and then see the price actions. That if it starts to roll off that might be a better short play than just buying, looking for that lifeline play. Anyway, guys, that is 5 signs a company is failing. Take care and keep risk management, whatever you're doing. Goodbye.